This content is for educational and entertainment purposes only. It does not constitute investment advice.
Ask any trader and they'll tell you that trading is a fair fight, that if you're smarter, faster, more disciplined, you'll win. So they dive into technical analysis, learn how institutions move, look for confirmation, refine their setups, and perfect risk to reward.
And on the surface, it makes sense.
Trading looks like a game of pattern recognition, played by humans, fueled by emotion, and governed by probabilities. So traders keep going deeper. More indicators, better indicators, more precision, more complexity. Because the underlying belief is, the better you get at reading the market, the more you'll understand what other traders are thinking. And if you can stay one step ahead of them, that's the edge. But that belief is based on one critical assumption, that the market is still being moved by humans. And that's where things start to fall apart. Because some price moves don't follow psychology. Some spikes are just too fast. Some rejections are too surgical. And some setups just don't behave. It's not random, it's not emotional, it's mechanical. If I'm not trading against other humans or even institutions, then who am I actually competing against? To answer that, we have to go back to 2001, the year US markets switched from fractions to decimals. You see, during the fractional pricing era, stocks traded in increments like 1/8 or 1/16 of a dollar, about 12.5 cents or 6.25 cents per tick. And that spread gave traditional market makers room to operate. It was slow, human, and immensely profitable. That sounds small, but it was massive for market makers. They could profit from the spread between bid and ask, or the space between what buyers offered and what sellers accepted. But then came decimalization, a quiet rule change that detonated decades of market structure.
The minimum tick size didn't just shrink.
It completely collapsed.
From fractions like 1/8 of a dollar.
Or 12.5 cents, all the way down to a single cent. In over just one weekend, the economics of market making changed forever. For the old guard, spreads vanished, risk increased, margins thinned, and retail traders cheered for this change. Tighter spreads, better fills, in a more modernized market. While retail cheered at what they thought was a game-changing advantage for them alone, the sharpest firms saw something else, an opening that would quietly change the game forever. You see, that tidy 1 cent increment made it possible to step in front of any order with a slightly better price, by a penny or less. But there was a catch. No human could ever react fast enough to seize this advantage. You'd need something faster, smarter. You'd need code. And that's exactly what two floor traders, Stephen Schuler and Daniel Tierney, realized in 1999, before decimalization was even confirmed.
They saw where the market was headed
and built for it. Their firm, Global Electronic Trading Company. And while most traders were still charting candlesticks, Getco was laying tables, writing code, and preparing to outpace the entire market, 1 penny at a time. By the time decimalization rolled out in 2001, they weren't adjusting to the new rules. They were already exploiting them. And over the next several years, Getco would go on to dominate. At its peak, it handled over 20% of all US equities trading volume, often acting as the market itself, not just a participant. The firm expanded globally, pioneered new strategies, and became a model of what speed and precision could achieve in modern markets. But with success comes imitation, and Wall Street took notice, fast. Every major institution in the country began racing to replicate Getco's edge, from building custom hardware, co-locating servers inside exchanges, shaving off microseconds and then nanoseconds from execution time. It wasn't about who had the best analysis anymore. It was about who had the fastest machine in the room. In one firm, named Spread Networks, reportedly spent $300 million to lay a straighter fiber optic cable from Chicago to New Jersey, just to shave 3 milliseconds off their trade execution. $300 million for 3 milliseconds. That's how fierce this race became. That change, sparked in 2001,
rewired everything.
The market had opened its doors to a new kind of participant, one that never hesitates, never gets tired, never blinks. And whether you know it or not, you've been trading against it ever since. Now, if you're like me when I first learned all this, you're probably thinking, what can I do about all of this? How do I stand a chance against an inhuman opponent?
The truth is, you can't outreact bots.
You can't outcode them, but what you can do is recognize when they're in the market and trade accordingly, because while they move fast, they leave footprints.
And that's exactly what Bot Tracker IQ was built to uncover.
Heads up, Bot Tracker IQ is a trading view indicator that unlocks when you register with our affiliate exchange.
It comes at no extra cost to you.
But if you sign up and place trades, we may earn a small commission. Now, Bot Tracker IQ provides a visibility layer over bot activity designed to detect abnormal volume, behavior, and flow.
Not based on candle patterns,
but on machine behavior. You might be asking yourself, how in the world could someone build something this advanced on TradingView? And well, with the inclusion of tick data, it's completely possible. You see, when bots strike, they don't trade like humans. They hit the tape with precision-sized bursts of volume, often identical, down to the share. They react faster than humans ever could, sometimes within milliseconds of a price move. And they don't just buy or sell, they repeat patterns over and over again. And this is exactly what Bot Tracker IQ tracks in real time. The indicator scans for suspiciously fast volume spikes,
detects statistical anomalies and flags when the same volume hits the market multiple times in a row.
A dead giveaway of algorithmic execution. You can't beat a bot at speed, but with the right tools, you can read its behavior and make smarter decisions because of it. Bot Tracker IQ uses green columns to show detected bot buying, while purple columns are shown as detected bot selling. And both bot buying and bot selling have classification categories based on percentile rankings. So we boil down detected bot activity into extreme, high, low, and average. In any time bot activity is detected as being extreme, you'll notice a red hash mark right above any of the green or purple columns. During this downtrend here, we can see two bot selling extremities occurred, and at the bottom of the downtrend during the reversal, the red hash mark shows that bot buying was detected to be extreme. Now, just because bot activity is detected as being extreme doesn't mean that there is a predictable price move or a major reaction is going to happen. So the examples shown here are purely for demonstration purposes. In knowing whether the algorithms are predominantly buying or selling personally helps me make more informed trading decisions, and I'm going to show you exactly what I mean. It's important to mention that when I personally use this tool, I do not consider extreme bot activity to be an indication of the long-term trend. When I see these red hash marks or increased bot buying or selling, I do not consider this any indication of what is going to happen over the next couple of weeks, months, and especially years. Remember, bots trade fast and are generally in and out of positions within a short period of time, and I use this knowledge to help plan where I think price might go over the next few bars relative to the time frame. For instance, you can see I'm currently on the daily chart, so when I see extreme bot activity, I personally view this as an indication of what might happen over the next few days. Please note that this method of analysis may not be suitable for everyone, as there are no guarantees in the markets, and individual results may vary. That said, there's also a prolonged period of time to where no extreme buying bot activity was detected until this candlestick. And for this specific example, this extreme bot buying activity preceded Bitcoin pushing into all-time highs. And even though this type of analysis is new to me and I'm still coming up with ways to use it that help improve my trading strategy, it's been helpful enough already to help me spot when a price move is due to high algorithm activity or just regular human traders. Hit the like button, drop a comment,
and subscribe if you want more videos that break down
the invisible forces moving the market. And if you want to try Bot Tracker IQ for yourself, there are instructions in the description. Don't forget to follow us on TradingView and Twitter because it really helps support the channel, and join our Discord server where we have active traders talking trading every day.